The financial market's dominant narrative is undergoing a significant realignment, with one of the biggest owners of Coinbase, a US-based cryptocurrency exchange, at the core of everything. More risky, growth assets, mostly equity in rapidly growing or creative businesses, have had a tough few months as innovation excitement fades and interest rates seem to be on the verge of a major turn. In their position, people are more interested in so-called value transactions, such as equity in already profitable businesses. For investors who took extremely forward-looking investments, this has resulted in significant risks and differing degrees of humiliation. The Nasdaq index, which is based on technology, has seen a lot of uncertainty and is still flat towards its mid-January mark. Chamath Palihapitiya, a high-profile specialist development investor who was only months ago a tireless and celebrated promoter of a kind of less transparent initial public offering known as a special purpose acquisition business, has suffered financial and reputational losses. ARK Invest, which runs exchange-traded funds that invest in fintech, genomics, and space exploration, has received a lot of coverage. Cathie Wood, the CEO of ARK, has been more of an investing rock star in recent years, due to a 45% annualized gain in ARK's flagship innovation fund, which has expanded to hold more than $50 billion in assets. However, the fund's value has plummeted by nearly 30% since mid-February, owing to severe losses in its stakes in everything from gene editing to Tesla. ARKK is also a major shareholder of Coinbase, which has lost 25% of its value since its IPO on April 14. In certain cases, these declines have been triggered by changing views about the future, which is perhaps the most significant danger of growth investment. Since the current price of growth assets is so reliant on expected future returns, even minor improvements in a company's earnings, whether good or negative, may have a major effect on the stock. The pandemic has perfectly encapsulated this. Since trendlines unexpectedly pointed to massive potential acceleration, lockdowns caused huge jumps in stay-at-home tech stocks. However, the reopening has brought those hopes crashing down to earth, causing ARKK to lose a ton of money. Rises in Treasury bond yields and inflation increases, which may prompt the Federal Reserve to raise interest rates more rapidly, are maybe perhaps more important than the reversal of the coronavirus pandemic. Bond yields and interest rates, in particular, pose a direct challenge to growth investing by providing more appealing returns on low-risk portfolios. Around the same time, higher prices raise the cost of loans and other forms of financing for development firms, which usually lack the cash reserves to finance their own expansion. When it comes to monetizing the future, there's no way to avoid certain kinds of threats. What counts is how a growth investor reacts, and if that reaction fits the same forward-leaning logic as the original investment theory. Wood is under fire right now as a result of ARKK's problems, but she's been nothing if not persistent with her reaction. She has stated consistently and emphatically that the current downturn in growth stocks is a purchasing opportunity, with lower rates just enhancing possible future returns. Debt and other capital for growth companies, which typically do not have the cash flows to fund their own growth, are more expensive with higher rates. We know Wood isn't only talking because ARK funds make their trades public. As the equity market falls, ARKK has been slowly purchasing properties such as Square, Twilio, and even Zoom. The fund is still actively purchasing the dip in Coinbase, raising its stake to 624 million shares as of today, accounting for 3% of ARKK's assets and more than 10% of all Coinbase shares. That's particularly bold given the fact that Coinbase is a growth investment. Squared, its own development is heavily reliant on demand for assets that are highly speculative in nature. Wood's trust in her bets is genuine, but it's also nice optics for a development fund. Stopping purchases on Coinbase or other bets when they fall in value will imply that prior purchases at higher rates were an error. Purchasing an asset that is falling in value in the short run is a clear indication of long-term optimism. Wood's consistency, as well as her track record, seem to have been successful in assisting investors in maintaining their confidence through short-term losses. It's understandable why certain investors will sell a ticker that has dropped 30% in 4 months, but according to Seeking Alpha, ARKK just saw $1 billion in cash outflows during the past week, only around 2% of the fund's overall assets. That's far from incredible, yet at that pace, it might easily add up. However, it is far from the worst-case situation. It's as much about honesty and confidence as it is about figures while selling potential gains to current customers.